Oh, they're quite strong. You know, the story with the banks is 18 months ago, 12 months ago maybe, they reached valuations that were at the high end of historical ranges, and that's why we said sell all the Australian banks, go offshore. And then what you saw is the Aussie banks came down probably 30%. And then what you've seen is when the global banks have corrected on the hysteria the last month or two, they've followed suit. So they've gone down further and actually got, I mean, ANZ was like on 8.5 times earnings and was looking pretty interesting from a valuation perspective. So in that environment, you know, obviously people are coming out with sort of short selling stories. And everyone knows that Australian banks are very exposed to domestic housing. I think it's about 60% of their balance sheet. So in a tail event where housing collapsed, the Australian banks would be under severe pressure. And I think people underappreciate it, but the reality is the environment we see, I suspect housing is just going to be a slow death, you know, provide very poor returns for a long period of time. And so it will never be a tail event that will put the banks in trouble. But it's a fact of life. If there was a California type experience where house prices fell 50%, the banks are in serious trouble. But that's not a scenario we see, but it's a very easy one to kind of beat up every now and then as a possibility. Yeah, well, it's been a crazy month, or crazy start to the year. Lloyd's Bank is the best example. You know, the thesis has been very simple. Clean up post GFC. Once they get to the point of having enough capital, they'll be able to pay cash dividends. And it looked like Lloyd's was on a 10% dividend yield, which in a 1 to 2% bond world is extraordinary. That was the thesis. Lloyd's Bank at the start of the year was 72p. By the middle of February, it was 55p. And you're sitting there scratching your head as to what's going on. Obviously, a lot of macro fear, collapse in oil price, Middle East, you know, what's going to be the impact, you know, China slowdown. But then they came out with their results and they confirmed that they've reached an inflection point in capital. And as a result, they're going to pay out all their earnings in dividends, and they're on an implied dividend yield of 10%. Stock was up 12% the first day, and now it sits above slightly where it was at the beginning of the year. So this crazy situation where not only have the fundamentals not changed, but there's been another tick confirming, you know, the thesis coming through, and we saw a 30% price volatility during the month. And that's just hard to explain, but sometimes you've just got to make sure you don't let the market force you into panicking about, you know, short-term noise and hold your ground, because 10% dividend yield is quite extraordinary. Yeah, I mean, the reality is markets are forward discounting, so you know, they're worried about 6 and 12 months, and so none of us have got a crystal ball, but right across the board in terms of earnings reports, in terms of the US economy, the Australian economy, we've had good GDP numbers. Everything is bang on line with what we would have expected. Yeah, slow growth, but forward progress. So it's a classic, well, actually, it's one of those weird months where the price action seems so divorced from the fundamentals. And then when we get to the end of the month, again, the fundamentals still seem to be on track. Even, I think on Friday, they had a great jobs report in the US. So it just keeps inching away. Yeah, I guess in hindsight, it looks like that was a huge opportunity 2 weeks ago.